Hello traders, welcome to today's live stream. Just give me a moment to set up. I was doing some research, so I completely sort of forgot the time then when I was doing that. So I'm a minute late. Apologies those that were waiting. What do I need to do here? Let's get some pen tools up. Let me know how you're all doing in the chat. Hopefully everybody's doing well today. There's no stream over on Facebook today. For some reason, Facebook's not letting us stream there at the moment. So unfortunately, we've only got YouTube and Twitter up at the moment. But we're going to be talking a lot about the Fed funds rate decision. We're going to be talking a lot about where we see the economy, I guess, going in the US. So I was just doing a little bit of research and having a look at various different things and different sort of indicators and stuff like that. So we'll have a little look at what I found and if it tells us anything, if it doesn't tell us anything. Also, we're going to have a little look at currency strength meter. We'll have a little look at what's going on there. We'll have a little look at what's coming up in the upcoming data. I haven't actually looked yet at the CME Fed Watch tool. We've had some data drop very recently, which was the US core retail sales. So we're going to take a little look at that as well and see how that's impacted the CME Fed Watch tool. And we'll go from there. So hi Ratish, hi Francis, hi Wizzy. It has been a while, Wizzy. I haven't seen you in here for a while. I hope you're well. Hope everybody else is well as well that's watching. Yeah, it's going to be an interesting week coming up. I think we've got a bit of a quiet week until we see the decision. But we'll talk about how this is going to impact the US dollar. How could this impact the S&P, for instance, in the equity market? How could this impact things like gold, commodities? Oil prices have been dropping a little bit. There's an interesting long cut report showing a potential long on oil at the moment, which I quite like the look of. So we'll also go take a look at oil prices as well. Usually a good barometer of what's going to happen next, especially in terms of inflation. But hi Bruce, hi CG, hi Tabo. Thank you for everybody for joining. As always, guys, any questions as we go along, feel free to drop them in. If you want to have a topic of conversation about certain things, let me know. Last week, I covered sort of using your risk reward tool to help you, find better entries and stuff like that. If you want to have another discussion on stuff like that, let me know. So let's have a little look at this data then. What did we have? Well, we had some CPI data out of Canada. Saw it coming at minus 0.2%. So that's quite a significant move. Lower for CPI. Core CPI as well actually fell to 2.4%, which again, very interesting, down from the 2.7%. Let's open this up here. You can see the trend for CAD is still lower. We've talked a lot about some interesting longs on CAD recently. Whether that's going to continue or not, I think, at the moment, the way the data's shaping up, it's pointing a little bit more to a bit of downside. Let me just put some music on, actually. I forgot the music in the background there. So, yeah, it'd be interesting to see how this plays out from a Canadian dollar point of view. Obviously, like I said, trim CPI is basically like your core CPI. So, if you look at this sort of statistics here, it measures the change in price of goods and services purchased by consumers, excluding the most volatile 40% of items. That's usually like your energy prices and things like that. And you can see the overall trend here has been to the downside. Interestingly enough as well, if we just kind of zoom into the recent reports, we've kind of missed forecasts to the downside on the two previous announcements or two previous releases there. So that's going to be something to take into consideration going forward. But we'll do more analysis on CAD soon. But yeah, US is where we're focusing a lot of our attention this week because we've got the FOMC Fed funds rate decision coming up, and that's a pretty big one. CG views on FOMC tomorrow. Yeah, let's talk about it. So core retail sales. I haven't looked at the CME Fed Watch tool since, right? So let's have a little look at what's going on, whether the pricing has changed considering the update that we've had in terms of the retail sales. So core retail sales is one you typically want to look for, right? And the reason being you want to look for that is because it leaves out certain things, right? Again, it kind of leaves out sort of automobiles here. And core retail sales will give you a more accurate picture of consumer spending, essentially. Are people still buying things at the retail level? Usually when retail sales is going up, there's a decent amount of spending within the markets. Haven't really had decent spending since March 2023. And, that is, we've kind of seen a significant sort of decline in the US since sort of the start of 2023. Obviously, February 2023 was quite a large bit of spending going on. But again, we misforecast to the downside here. So I'd say that's quite a weak result for the US dollar. Again, I haven't actually looked at any charts. Let me go have a little look at the DXY, see what we're doing at the moment. So we're seeing a tiny bit of upside here. I'll show you what I'm looking at in a moment, but I can't really hide it. Basically, that's the Fed funds rate at the moment. Let's have a little look at how this has reacted. So we've had a little bit of a bullish reaction here. Again, I don't think we're going to see much reaction until the Fed funds rate decision tomorrow. And I'm looking for potentially a bit of a bullish reaction to the US dollar because we can see that we've had a bit of a pricing in of the Fed funds rate at the moment. But let's go back to this. So the CME Fed Watch Tool hasn't really updated, hasn't really changed. Yesterday it was at 62%. A week ago, though, it was at 34%. And a month ago, it was at 24% on terms of chances of getting a 50 basis points cut. Now you can see here we're weighted 67% to 50 basis points. So the market is at the moment pricing in a bigger cut from the Federal Reserve than what is forecasted, right? If I go over to Forex Factory here, just go have a little look at what's going on tomorrow, you can see that Fed funds rate, they're expecting or forecasting that it's going to drop by 25 basis points. If I come over to the calendar on tradeandeconomics.com and we have a little look at what's going on here, they're also expecting it to be 5.25%. So they're also looking for a 25 basis points cut. But the market wants 50. Okay, the market wants 50. Why does it want 50? Because if we go all the way to December, they're looking for rates between, sort of 400 and 425, right? That's where they're expecting the rate to be at, right? Now we're at 550 at the moment, so they're expecting at least 125 basis points of cuts to come before the end of the year, right? So what the market is foreshadowing or expecting or wanting, right, is 50 basis points cut in this meeting. If we go to the next meeting, they're looking for a 25 basis points cut in the next meeting. And then when you go to the 18th of December, they're actually pricing in from that point another 50 basis points cut, which is quite a lot. And I think this is when and where we're going to find this information out, whether they will or not. It's all going to come in tomorrow's meeting. It's all going to come in that press conference after, and it's all going to come when Federal Reserve Chairman Powell gives his future outlook on monetary policy. If he starts talking a game of yes, we need to cut, and we need to cut aggressively, we need to get ahead of the curve now, then the market may feel like the Fed missed the window in July, and that might cause a little bit of volatility, might cause a little bit of panic within the markets. Do I think that's going to happen? Not necessarily, right? And the reason why I don't think it's going to happen is for a number of reasons. First of all, the unemployment rate, right? The unemployment rate at the moment is at 4.2%. Yes, it's the highest it's been since 2023. But if we look at it over sort of a max period here, usually you need to start getting concerned with the unemployment rate above sort of 5%. Labour market has slowed down significantly. If we have a little look at, let's have a little look at NFP, okay, non-farm payrolls here. And again, I'm just going to put it up to over a year here. Let's just put it on a line graph. You can see that on average, you know, non-farm payrolls are showing that we are seeing a cool off in the labour market as well. So this is the main reason why they're going to be cutting interest rates, because the unemployment rate has started to slow, and we're starting to see that sort of become a little bit of a problem there. Has that impacted inflation as well, right? Because the reason central bank will move rates is due to employment and due to inflation, right? So if we go up to indicators here and we just have a little look at the inflation rate, okay, we're at 2.5%. That has been on a significant decline, right? If we look at a 5-year period here since we peaked in June of 2022, we've been moving, and we've got past that sort of sticky 3% area, right? So that's why I think we're starting to see the Federal Reserve really looking to want to cut those interest rates as well, because they can cut rates because inflation has come down. If we look at core inflation rate, okay, so this is the core inflation rate year on year, we're sitting at 3.2%. Again, if I go to a 5-year period or even a 10-year period, that's still fairly high, right? It has cooled off. We're at 3.2%, but you can see back, you know, prior to COVID, we were sitting around about 2.3%, 2%, things like that, right? So it was on a slow incline, but it wasn't anything that would be, you know, anything concerning. You know, the concerning time really come through April 2021, when we started to see those significant increases, which then obviously followed interest rate hikes. But we are starting to see that cooling off now, but we are still above the targets that the Federal Reserve would set out, which is somewhere between that 2% and 3% area. Okay, so they would want it to be a little bit lower. That's why I still feel we will get a 25 basis points cut rather than a 50 basis points cut. But I might be wrong, right? I might be wrong. You know, it'd be interesting to see how the Fed plays this out. Now, what I was looking at actually was something that I was speaking to Jordan about this morning. We were looking at the US 2-year yields, right, and how the Federal Reserve or how the Fed funds rate reacted to that. Essentially, I'm just going to take off the moving average for now, because I was looking at different indicators and how different indicators were formed when it comes to looking for turning points within the market. But typically when the US 2-year yields decline, we can see that the Fed funds rate starts to follow that, right? When we see sort of a bottoming out of the 2-year yields and then an increase in the 2-year yields, the Fed funds rate goes up, and so on and so forth, right? Now, you can see we've been holding for quite a while, but now US 2-year yields are now starting to drop, and there's a concerning sort of low here, right? Now, one thing I was looking at was, you know, very similar to other indicators out there, sort of how price reacts to sort of averages and things like that, and can we kind of foreshadow any type of moves really in the Fed funds rate. And what I was looking at, just to see if we had sort of a break of the 100 moving average, right, when it comes to the US 2-year yields, how does that impact inflation, interest rates going forward? So you can see we kind of had a clear break here back in 2013, and we were trading above the 100 moving average. Eventually that sparked sort of interest rate hikes, and because yields continued to drive higher, rates also went higher. We started to see them cool off a little bit, and we broke the downside of the 100 moving average here, and you can see we then followed with a rate cut. This is a weekly chart, by the way, so 1, 2, 3, 4, 5 weeks later it was followed by a cut by the Federal Reserve and a move lower. We broke it here in 2021, right, where we were holding rates very, very low. We started to see that, and about 4 or 5 weeks later, actually it was a lot longer, it was about a year later, we started to see the Federal Reserve hiking interest rates. We've now broken this again. Okay, we've broken this 100 moving average. It's been about 6-7 weeks now, and yet Fed funds rate has remained the same. So I think this is a good sort of visual barometer of where the Fed are likely to move to. Okay, obviously we need a bit more research on this. I was literally researching this before we were going live. I was having a little look at when we broke through the 100 moving average here on the 2-year bond yields, how that impacted price going forward. And like I said, this was a little feature from a friend of mine that I spoke to this morning, and we were looking at how this impacts the market, and it's just got me interested into having a look at how it does, or if it does signal anything. Very similar to this. I don't know if anybody knows this. Has anybody in the chat heard of the SARM rule? You might have heard of it. I'm going to give you a brief of what it is. So let's type in the SARM rule, right? Because I'm going to butcher what it is. But basically, the SARM rule was created by Claudia Sarm, okay, who is a macro and analyst, and pretty sure works at the Federal Reserve. I'm not 100% on that, but I'm sure she does. It says something here on Twitter about the Fed there. But I'm not 100% sure on what if she does work for the Federal Reserve or not. But basically, the SARM rule is a recession indicator, right? And it got triggered a couple of months ago. It got triggered, but she was saying that it's not in the same conditions of when it's been triggered before, so it kind of downplayed the recession risk here. Now, the SARM rule is a recession indicator that states that a recession has begun when the 3-month average of the US unemployment rate increases. Okay, so increases by 0.5 percentage points or more above the previous 12 months low. Okay, here you go. It was here. I didn't even read this bit. Economist Claudia Sarm created the rule after working at the Federal Reserve for a decade, right? The SARM rule has been accurate in signaling every recession in the US since the 1970s. However, Sarm has noted that the unemployment rate can increase for reasons other than people losing their jobs, such as when people are looking for work as well. And that's something that needs to be kind of thought about as well, because we saw a lot of Fed members recently coming out saying that people aren't necessarily losing their jobs. It's just that businesses aren't necessarily hiring at the moment. And obviously that could be a factor in this. But you can come and have a little look at the SARM rule yourself if you want. I'll just pop this in the chat box for whether you want to have a little research of this yourself. While I'm having a little research of it, I'm using my screen time here to research with you guys. But these are sort of the instances that it's happened in the past. If we go all the way back to 1960, this is all the sort of grey areas here, okay, is when we've seen a recession within the market, right? So you can see all through 1970, 1974, 1980s as well, obviously 2008, and then that quick sort of market flash crash of 2020. And what it looks at is this little crossover here, essentially, where we get above the average of those 12-month lows, right? So what's interesting right now is we're at 0.57% according to the SARM rule here. Now, the last time we had a significant trigger, and I'm ignoring COVID because COVID technically a little bit of an outlier, right? So I'm zooming in more towards what's happened in sort of 2008, and you can see in 2007 it was at 0.4. Okay. Now I would love to be able to add something on top of this. Add line, right? Okay, let's have a little look at Fed. Let's see if we can get this up. Funds. I've never used this platform before in my life, so I've just found this. So summary of economic projections, Fed funds rate medium, projections for the Fed funds rate medium, projection of the Fed funds rate low, summary of economic projections midpoint, kind of midpoint maybe, Fed funds affected rate. Let's just see if we can add that data series onto this chart. Okay, right. Interesting. So basically what I'm looking for is we're about to go into a cutting cycle, right, for the Fed. And there's a lot of similarities between the price that's going on now and 2007 price, right? Now, guys, I don't know if you follow it along or not, or whether you think this is boring or not, but I'm kind of, like I said, using this research, using this time to do a bit of research. But let me go to the SPY. Let's get the. Actually, no. Let's not go to the ETF one. Let's just go to the. Let's just go to the S&P. Let's just grab the futures. I want to take off the Fed funds rate, but I want to keep it at the same time. I'll just remove it for now. Right, what I'm going to do is just go to a daily chart, right? And I'm going to side by side price. I'm going to put this on a daily chart as well. This is current price, right? So on the right hand side, we're going to go back to 2007. I need to turn that time interval off, don't I? That would help. So let's leave the daily chart here on the left. I can just click that button, can't I? There we go. That helps a lot. And I'm going to go to 2007 over this side. Because I just want to show you the similarities between the 2 years. Okay. So this was September. What are we on? We're on September 17th now, which was here. Okay. And this is what we're on here. Right. So there are some similarities in the way price sort of moved in 2007 and 2024. Obviously, you can see here that we had a rally up in price, okay, through sort of March through to July. Here you can see a very similar pattern as well, where you've got April, May, June, July. We then had a little bit of a stall in price and the market fell through August. You can see we had a familiar sell-off in August of 2007 as well. And then we're on the rally, and that's what happened here. We've even had sort of a move up and a bit of a consolidation before a continuation. So there's very strong similarities between 07 S&P 500, 2024 S&P 500, right? And we're in a similar situation. So if I just bring this back, whether this helps or not. Now, so what's this chart? So it's got the real-time SARM rule recession indicator, right? And then we've got the federal funds effective rate, okay? So you can see which is up at the moment at 5.33%, okay? Now, typically, or in the past, when rates have been higher and then the Federal Reserve have cut rates, it can be reflected of sort of recessionary periods, right? Now, just to kind of, what's a little bit scary, which I've never looked at this chart myself before, but I'm just kind of saying it out loud with you now, is if we have a little look at 2006, 2007, right? Especially when we started to cut rates in September of 2007, the SARM rule hadn't triggered yet, right? Hadn't really triggered yet. In fact, we were at that sort of, it was sort of a couple months later where we started to see that sort of trickle in. So we had the Fed cut in September of 2007. And then we started to see the SARM rule coming into effect in December, okay, which then accurately predicted the sort of economic downturn that we had, which is this grey box here. You know, are we going to see maybe something very, very similar again, right? We've got the increase here on the SARM rule recession indicator. And then we've got the potential for the Fed to start cutting rates. Now, it's going to be interesting to see how the market starts to take that. I mean, there's instances in the past here as well where we've started to see the Fed cut rates. So this is 2001, Fed cut rates, SARM rule got triggered, right? And then we saw a little bit of a recession there. We saw it here as well. Now, this was a little bit different because there's a lot of chop before it. But 1989, we saw the Federal Reserve starting to cut interest rates. Then we've seen the SARM rule kind of come into effect and then move. So we could be looking for something very, very similar here, right? The only difference really would be back in the sort of late 70s, early 80s when we had that sort of, I guess, hyperinflation due to them cutting rates aggressively. And then them hiking so much that they were hiking rates so much that we saw them basically cause a recession. But yeah, that's just an interesting chart. I've never actually looked into this. So let me know your thoughts in the comment section, guys. Do you think I'm waffling on a little bit there, or do you think it's an interesting chart? Because that's something that's just interested me. I've never looked at this chart before. But what's scary to me is just the similarities between what's going on here in 2007 and what's going on here as well. So that's at 0.57. When was the last time we'd reached a... .4, that one was 0.4. Obviously, this is relative to the 0.5 percentage points or more from the previous 12 months low. Anyway, super interesting chart, I find. Let me know your thoughts. Let me know what you think about that. I might keep that to the side so I can do a little bit more research on that a little bit later. But yeah, FOMC coming up. Where are we situated? Very similar situation to 2007. What happened was Federal Reserve cut interest rate. Everyone said that would be absolutely amazing for equities. We're in a very, very same or similar position at the moment. Everyone thinks that that's going to be pretty good for equity markets like the S&P 500, and we're approaching all-time highs again. At the time here in 2007, it was all-time highs, and then we had this turnover and ended up having the 2008 economic crash. And we've been in a very sort of positive light since then. There's been a couple of market corrections, but if we look at how the market has moved, since that sort of crash, we have moved a significant way. And the market has to do these sort of resets every now and again after sort of points of prosperity, right? But it's just interesting to see. For me, I think one of my ideas that I had before was the fact that I can see the market breaking all-time highs again, because I think the market would take cuts positively. It's not always the case, but I think they'll take these cuts fairly positively, because I think they think this is almost like a cut based on the idea that they've called inflation down and that the labour market is starting to become a little bit fragile, right? And they don't want to see too much fragility within that labour market, because it can be quite concerning. So we've had this kind of rebound here now. I'll be interested to see how price does above these areas here. do we see price kind of come back down and then start to see big moves back to down towards kind of these lows in here. Now, I'm just going off, you know, how price has been reacting to previous years. You know, I always like to look at the correlations between certain markets, and I think that's something that's of interest to me. So hopefully you find that interesting as well. Let me know if you do. We'll go check out sort of the dollar index as well. Where's that positioned at the moment? I think this is in a very interesting position when we kind of look at sort of where we are in terms of the weekly chart. You know, we're in that sort of 101 handle. You know, has the market sort of overpriced this move? And I think if we get 25 basis points and we don't see, well, I think if we get a 25 basis points cut and we don't see the Fed necessarily saying that there's going to be 125 basis points of cut before the end of the year, I think dollar rebounds, and I think we start heading back much higher, you know, especially if we can breach this kind of 101.90. If we get the 50 basis points cut and then the market thinks there's going to be further cuts based on Powell's comments, then we could try and test these lows that were formed in July 23rd. But the important thing is we're kind of at a critical point. I don't know where commitment of traders report is kind of sitting at the moment. Let's have a little look. We can have a little look at 2 reference points here. Let's go to markets made clear and have a little look at how it's being shaped up here from a commitment of trader point of view. But I don't think there's too much going on. The only thing I saw last time was there was a lot of buy-in from non-commercials, which was quite interesting. If anything, look, commercials are more on the short side of things at the minute. If we look at the short contracts from commercials, they're selling right now, and they're not selling at extremes that we've seen sort of in the past, right? So that could lead to a little bit more downside in the US. Looking at the non-commercials, they are decreased short positions and even decreased long positions. A couple of weeks ago, they were increasing those longs down at these areas here. And we even had long contracts at the highest they've been since 2022. So that was something of interest there. Short contracts here, also at significant levels as well. Let's have a little look at those shorts, actually. Are they at extremes? So they're kind of nearing extremes. I want to see an extreme that was familiar to January 2024. Kind of in and around that area. So who knows? This upcoming data might influence some further selling from the banks and whatnot, which could then obviously lead them into something else. If I go to COT report simplified, let's have a little look at how this looks from the point of view of long versus short contracts. So let's have a look. Long contracts. See, you know, this is the non-commercials, futures only. So this is basically your large speculators, your hedge funds, traders, things like that. They were adding to long positions quite significantly. On the 27th of August, we saw quite a heavy long. That to me would signify some bearishness, right? So if we go and have a little look at the 27th, so that's for that week closing here, that would signify bearishness to me, because you want to do the opposite when extremes are felt. So we have seen that downside since then, but you can see that they've taken off those long positions over the past couple of weeks, and they've gone fairly neutral at the moment, which is something quite interesting. Sorry, I've missed some messages. Hey John, once in a while do a giveaway at least 5k. It will help boost the channel and also promote Blueberry funding. Yeah, there's probably some idea of doing that in the future. At the moment, Blueberry at the minute are just sorting some things behind the scenes. I'm sure we'll be able to give you some updates in the near future on something like that. Hopefully I can do something like that. That would be really good to do, I think, and be able to kind of share with you guys. So I would love to do that. But yeah, at the moment, we're not quite at that stage just yet, but it's a really good idea. Thanks, Wizzy. Ratius, which currencies would you look at? So there's a couple of currency pairs that I'm interested in this week. A lot of it focus has moved to the Japanese yen. One currency pair that is very interesting to me, or one currency that's very interesting to me, is the Mexican peso. Again, just kind of looking at this from a commitment to trader report point of view, we're starting to see an increase in those sort of long contracts here. Short contracts have sort of fallen off a cliff at the moment, although shorts were at sort of all-time highs back here, and we've seen that sort of move down. So we're starting to see a little bit of a pickup. I like the idea of potentially buying the Mexican peso against the US dollar at the moment, which we'll have a little look at. Swiss franc also is very interesting, starting to get potential signals here for a little bit more of a move lower. Okay, so we're starting to actually see short contracts increase to levels that we haven't seen in a while as well. If we look at the short contracts here, they're nearing sort of levels that we've seen back in 2021, where we saw this little period here, which is quite interesting considering where we're at. So the Swiss franc is something I'm looking at quite closely at the moment. If we go take a look at dollar Swiss chart, you can see that we're still sort of hovering around these lows, these weekly lows, down here towards the 0.84 handle. So I like the idea of potentially selling Swiss franc and potentially up into 86.75. And then if we do see quite a strong cut signal, then I like that upside there. It's just hard to tell when this is going to turn around, considering we've got such strong dollar data coming up. We actually saw some decent Swiss PPI numbers out earlier this week, I think on Monday. So other than that, I like the idea of getting involved with Swiss franc short. It's just where you'd want to do that. At the moment, I'd like to see some kind of support being held here first. If we look at the daily chart, you can see we're just basically chopping sideways at the minute. So I want to see CAN price sort of break out of that. This was a target that I like the idea of. I was long last week and I got stopped out. So I managed to get long around this kind of level. This is a daily chart. Yeah, daily chart. So in these levels here, after this kind of bullish sort of candlestick. So if we go to a 4-hour chart, it'd be easier to show you. We basically had a strong rally, right? And then on the retrace, I got involved. Market rallied and I thought this was doing pretty well. And then it came back and knocked me out for break even. And now the market's just kind of chopped sideways. So I thought breaking these highs here would influence a little bit more upside, and it didn't. Although I do like this sort of short selling on Swiss franc at the moment. Thoughts on CAD? So CAD's an interesting one, right? Obviously, we've seen some bearishness. This is when we were short dollar CAD. Like the idea of being short dollar CAD through 139, and that was again the commitment to trader reports showing us that move. But we're back at 136. 136 is a big level. You could argue from a technical perspective that we've traded through the level, we've come back up. Market stalling could see some further downside again. What is this going to take? It's going to take the Canadian dollar to get stronger. It's going to take the US dollar to get weaker. Yet your dollar index is at major support, right? So we're going to need something incredible to take that away from there. If we just have a quick look back on where did the COT reports go? Did I delete that? Oh no, here we go. Let's have a little look at COT reports with regards to the Canadian dollar, because I don't think it's saying a lot, right? So this was where we were looking at longs, right? We were looking at longs down through here in at this range low, which turned out to be a really nice move. But what are they doing now? Well, they've decreased those long contracts, which makes sense because price went up, right? And the commercials are into hedge. And they haven't really increased shorts though. So the net's kind of fairly low. It's mainly on the downside. If we look at the non-commercials as well, are they selling Canadian dollars? Not really. Are they buying Canadian dollars? Not really. You know, if you look at that chart, that doesn't give you a real sense of what's going on here. You know, that to me means that we're not really seeing much out of it. You know, they've decreased buying, they've decreased selling, they've gone fairly neutral Canadian dollar at the minute. If we look at the COT report simplified here and we go over to CAD futures as well, you can see in this information here that the market is pretty neutral right now. And the way I can tell that is, if we look at where the extremes were being felt, right? So we were talking about the extremes here. So this is the non-commercial. So when you're looking at the commitment of trader reports and you're looking at things like the non-coms, you want to be following the pressure, right? So they were selling, and you can tell that they were selling because the short side column here, okay, you can see was starting to sort of increase. It was going to sort of the 102s, 126s, 170s, died off a little bit here between June 25th and sort of the 9th of July. Then it started to pick up again. Now, what really was kind of crucial and critical to us was the 30th of July report. So basically, they were selling at levels they have not seen for a while. And that's something that we reported from Markets Made Clear as well. If we go over to Markets Made Clear, they were selling at levels that hadn't done for a very, very long time. I think it was they were selling at levels that we haven't seen since the 80s or something. You know, they'll go back in time. You know, it's the most levels they've sort of ever held short, right? So that's why we were very interested in getting long, right? Because they almost become exhausted and they want to take off those profits, and the extremes is what you want to look at, right? So you can see there it says 219.989. That's similar here, right? 219.989. Can you see that, guys? Sorry, I think I need to zoom in a little bit. Don't know whether I can. Oh no, it seems to. Can I zoom in on that? Maybe if I don't know whether this will work. Right, let me see if I can zoom in on this now. Edit, file, tools, pen, highlighter options. Okay, that's not really what I want. I want to zoom in. Doesn't look like I can zoom in. Okay, well, I'm not going to be able to zoom in there. Let me see if I can change the screen. Don't think that's helped too much. Well, anyway, right, you kind of get what I'm on about here. This is why it's easier to have it as a visual representation, like on Markets Made Clear, than it is just looking at the reports. But just check out the coloration of. Here we go. Here we go. Oh, it's working. No. Let's see. How far can I push it? Here, probably here. You can see the coloration of the cells, right? So basically, the coloration of the cells is showing us that they're selling at rates that they haven't sold at for a while, and it becomes aggressive. Sorry if you can hear an alert going off. And you can see the open interest as well. The open interest was at 351,856. It's very aggressive as well. And you need to look for these extremes if you're going to be looking for COT report sort of trades. The problem with trading week to week with COT reports is that sometimes you're going to be doing nothing for a while because, you know, there's not too much in terms of extremes going on. all the time. So that's why you can go and look at sort of commodities like cotton at the moment as a 100% buy signal, and you can see we're starting to break out of significant levels on cotton with the COT reports. What's going on here? Well, you can see that non-commercials are selling at aggressive levels. You can see from the commercial side of things, longs are at levels that we haven't seen for a while. They've surpassed these ones here. Okay, so we've got these longs there, right? And then a few weeks later, price moved higher. These longs here, price moved higher, right? And, significant longs coming in around this couple of weeks, and price, went sideways, but stayed elevated. So cotton prices, could be about to break high. You've got this nice little break of sort of trend as well going through this area here. Breakout there. Could that mean that we're going to see higher cotton prices and stuff? But yeah, so community trader reports are great. I think they're really useful tools. From a week to week basis can be a little bit tough. But also you want to just be looking for those clear-cut opportunities anyway. So at CAD at the moment, they're fairly neutral. If anything, they've decreased long positions last week and decreased shorts. So open interest pretty flat. Japanese yen is quite interesting though. The Japanese yen, this is why I'm focused on yen at the minute. Look at the long and short contracts here from the Japanese yen and look at the open interest, right? We're at 376,000. So look at the coloration of the cells here. I'll try and zoom in one more time, see if it'll let me. That's the wrong button. Right, let's reset. Move around a little bit. Trying to finesse the system. Okay, right. We'll not play around with it. There's a bit better. You can see the coloration of the cells here, right? So this is the longs, this is the shorts, right? Now, obviously, the Japanese yen has been getting stronger, right? So we're starting to see the long positions in the Japanese yen increase substantially, okay? Shorts as well, fairly high still, right? Or fairly low on the short side. You can see that we've started to decrease quite a bit there. So they're getting aggressively long Japanese yen, which is dollar yen short, okay? Which is dollar yen short. This is why I feel there could be a good opportunity on the yen right now. I had an alert go off for Aussie yen, which is basically looking at this zone in here, right? Starting to see a little bit of potential in terms of, if that breaks out, could we see some upside? Now, currency strength meter at the moment is saying that I want to be bearish Aussie yen. And the likes of CAD yen. I've talked a little bit about CAD yen this week in terms of looking for potential short opportunities on CAD yen, because the yen is still strong. My only thoughts are those weekly reports, and if we have a little look at the weekly chart here on dollar yen, we are at a very interesting low, right? It's this low that formed back in December, and we are trying to find a little bit of support in there. Okay, now just because the community trader reports is saying that non-commercials are selling buying yen at aggressive levels, doesn't mean that we're going to get like a huge reversal and the market come all the way back up into the 160s. I don't think that's the case, but let's think about the risk reward ratio tool, and let's say we want to be short dollar yen, right? So let's say I go short dollar yen right now. Where is the safe stop loss? Okay, and I always talk about this. Where's the safe stop, right? Safe stop for me is above 149.75, right? So arguably you want to be above the 150s with your stop loss, right? So where do you want to short dollar yen? Okay, let's look at targets as well. Let's say your target is 137.75, right? Because it's this zone in here. Okay, now I don't necessarily want to be short now, because, you know, I think that that's bad value. There's only a handful of pairs which I think could be good in terms of yen strength, but also because of the counterparty of weakness. But if I was really going to get short this market, where's the best place to get short? It's up here, right? Because look at how your risk reward ratio changes. Okay. That to me is something of interest, right? Can we get a move back into these areas here before seeing a continuation to the downside, right? I love following weekly charts. I think they're really good. If we look at the daily chart as well, look at the sort of stochastic, we are starting to be in that sort of oversold condition again. You know, could we start to see a little bit of a change here for a move back to the upside? If you have a little look at markets made clear, Vincent's just pointing this out as well. Yeah, markets made clear have been saying we need to look at short Japanese yen. You know, it did give this signal for a while, and I said it's probably not ready just yet. You know, I quite like the idea of price coming up into highs here, which is yen futures, which is that December low that we talked about on the dollar yen chart. So this is a yen futures chart, so this is flipped, it's inverse, and you can see we're at that resistance point now. Okay, look at the long and short contracts, right? So short contracts now are at significant levels, right? If we just open this up and let's try and go back and see where those short contracts are. Look at that, right? Look at where short contracts are. They have surpassed, and I mean, I don't think we had that we haven't had that the week that we were looking at in the past. I don't think we were kind of at similar levels, but now we've surpassed it quite significantly, right? So what does that tell me? It tells me that commercials are hedging, and it tells me that they are buying Japanese yen, selling Japanese yen aggressively, right? Because they're hedgers, they're hedging the market. If we have a little look at what the non-commercials are doing, they should be buying at aggressive rates. And this is what I wanted to see. I wanted to see them buying at rates that we haven't seen for a very long time, right? So if we have a little look here, let me just zoom this in a little bit. Can you see this okay as well, guys? Hopefully you can. Let's look at 2016. Okay, look at 2016 in here. Look at the long contracts from non-commercials. Okay, so this is your hedgers, right? This is sorry, not your hedgers, your actual traders in the market. They are buying Japanese yen aggressively at these levels here. And look what happened to price. We saw a reversal in price, okay, for a number of weeks after that. We're now approaching very similar levels to that. So the difference between sort of a couple of weeks ago that we were looking at, if I just zoom in again, this is when we had the commitment to trader report signal short Japanese yen, right? I didn't like it. I didn't like it because when you look at your short contracts here and you look left, okay, I'm going to have to open this up a little bit more. Yes, we were at extremes, but we weren't extremes that we've seen before in terms of, you know, aggressiveness, right? Now, if we look at the non-coms as well, because I like to see it on both sides, right, where we have the signal. If we look left, we were close, but we weren't really too, well, we were close, but we weren't at the point of extreme. But if I look right now, or look left now, we're very, very close now. Very, very close to that potential turning point, okay? So I quite like this in terms of short in Japanese yen. The problem with commitment of trader reports is timing. You can't really time anything with that. You know, it's very much like dollar CAD gave us a sell signal for 2 weeks before it hit that 139, and then it obviously dropped. So there could still be a little bit of room of downside for dollar yen before the rebound, okay? But essentially, if I was going to be a buyer of Japanese yen again, it'd have to be up towards this resistance zone up here. The only exception I've got is really CAD yen. I did quite like the idea of euro yen short as well, but we're not in the levels where I want to be short anyway. CAD yen I quite liked from an intraday perspective. If we look at the weekly chart, quite like the idea of selling towards this support zone where I've got sort of 101.70s and then expect a little bit of a rebound in here, right? If we have a little look at the 4-hour chart as well, we're approaching a strong level of resistance, which I've got marked as 104.30s. Okay, so really speaking, if price gets into here and I see a setup, still happy to be short. I feel like I'm still happy to be short, but in the very, very near term, right? Anywhere between sort of the 102s, I want to get out of that. You know, I will get out at the lows as well if it does get there, obviously. If it doesn't, then, you know, price is obviously probably going to stop me out of the trade. But I still quite like the idea here because, like I said, although we've got the signal from the commitment of trader reports, which I do take a lot of weight in, I do think it's a good thing to have a little look at. Are we going to see that reversal just yet? You know, I'm not too sure about that. CAD data has been pretty poor. I don't know how CAD's performing across the board so far. Looks to be a little bit stronger. But dollar CAD is at this resistance point, so we could expect a tiny little bit of CAD strength coming through, which could keep it around this level. If this starts to break lower, that is CAD strength. So if it breaks higher, that's what we want to see in order to be CAD yen short. We want dollar CAD to move lower. But at the moment, we don't have a setup, right? We might not even get a setup. You know, I'll be looking at sort of the 30-minute time frame, 15-minute time frame. I'll be looking for price to punch into this zone and do something like that, right? So I've got loads of time to think about this, loads of time to see the setup play out or not. But I just thought that is quite an interesting thing to have a little look at. You know, arguably as well, we have come into this support zone here. So maybe yen, maybe buying yen could be a little bit tricky. We do have a BOJ decision as well at the end of the week. I might have just talked myself out of this trade. Might have just talked myself out of it. Yeah, I do like where the non-commercials are as well, especially when you look at it here. You got this aggressive green coming in. Pound's looking pretty decent as well. Starting to see some strong coloration here. Maybe pound yen. Pound yen might be a good trade. Because again, if you're looking at pound yen, where do you want to sell pound yen from? You know, looking at the daily chart here, you know, I want to be selling pound yen up here if I was going to sell it. So does it make sense to try and short this right now? No, it doesn't. So maybe we're on the lookout for a little bit of a yen weakness. But again, it's a difficult week to try and pick this up because I don't think we should be looking at necessarily trading major markets until after tomorrow. Like I said, I quite like dollar peso. Let me get rid of all these notes. Quite like short dollar peso at the moment. I quite like the idea of this. Let's have a little look at the 4-hour time frame. I think if we get an interesting move higher, quite like the short here on dollar peso. Again, that's more commitment to traders report though, that I want to be a buyer of Mexican peso. Let's have a little look at the COT reports here as well. Let's have a little look. Exotics. Mexican peso. Yeah, look, they're starting to get aggressively. I was going to say aggressively short, but they haven't got aggressively short. Longs have started to fade off. When's that? 18th of June. Let's see what happened on the 18th of June. I always try and compare price to what the reports are saying, just because I think it's good for you to do. So let's have a little look. 18th of June, what happened with price? It's probably some kind of low being formed or some kind of sell-off. May, June 18th. So that's that week there. And we saw a heavy decrease in long positions, which makes sense because that's dollar peso higher, which is short peso, right? Okay, so the turning point probably came in March to April. March to April, yeah. So where did March start? March started here to April. That was the turning point. Okay, I know that was the turning point because if you look at the Mexican peso futures here, you can see, look at the longs on the peso there. Okay, very aggressive longs coming in. 2nd of April, we saw the most longs that we'd seen in a very, very long time. So the 2nd of April and the 9th of April really was the turning point for price. That's these 2 weeks here. I mean, that's good information, right? If you can see that banks have been buying aggressively of Mexican peso, and then you see that signal from the commitment of trader reports. So that is a decent commitment of trader report signal there, isn't it? Because look what happens then. Peso sells off aggressively, comes back, sells off aggressively, comes back, sells off aggressively against the US dollar, right? So that's quite interesting to see that cut signal there. So this is why I always look for the extremes, because I think the extremes give you really good turning points. So it's about trying to find if there are any extremes going on at the moment. Not bothered about crypto. Gold, starting to get there a little bit on gold as well. Open interest is a little bit low on gold at the minute, but you can see that we're starting to build back up on long positions on gold. Silver, short positions have decreased quite a lot. They were heavily short silver on the 20th of August, 13th of August. Let's have a little look at how silver played out. 20th of August. That's this week here, really. Price has since moved higher, but it did decline for a couple of weeks first. So yeah, it's not really showing me much at the moment. Markets are very, very quiet. I think it's all down to what happens at the FOMC this week. Copper, short positions are high apparently. Open interest is very low on that. Let's see how oil's doing, actually. I like the idea of being long oil. Again, why? If we go take a look at crude oil, 100% signal here. Take off the net, you can see that long contracts are at significant areas. What's really interesting is where the short contracts have just come into, right, into previous extremes here. I would like them a bit higher, you know, back into levels like this that we'd seen up in the 177s. We're just above the 150s at the minute. So it'd be interesting to see where oil prices go at the moment, where maybe we could take one more leg lower before looking for a reversal in oil prices. But this is something that's interesting me as well. Oil is up today, and it has been up sorry, let me just take off all these lines. It's just a strategy indicator that I'm working on at the moment. And it is a little bit bullish here. It is a little bit bullish. So we'll see if that can continue higher. I wouldn't mind another leg lower in oil to then look to potentially buy that. Two-year yields up today, 1.37%. Okay then, guys, we're going for about an hour or so. I'm going to leave it there. Not a lot going on in the markets at the moment. Obviously, we've talked about the potential for Japanese yen reversal coming up. But again, we've got to be super careful going into the FOMC. I'm probably not going to trade until after the FOMC announcement. Thursday, we'll talk about the Bank of England, and we'll talk about the sort of results of that, and we'll talk about the Bank of Japan results as well. And then hopefully going into next week, we've got a little bit calmer water to try and trade again. So I'm going to leave it there. Thanks a lot. I hope you enjoyed the content that you've seen today. Maybe it just opened your mind up to looking at different things and thinking outside the box a little bit, hopefully. If it did, leave a thumbs up. I would appreciate that. And I will catch you on Thursday. Cheers, guys.